Joining me now, Jeff Hart is senior bank analyst at Piper Sandler, and Ken Zener is home builder analyst at KeyBank Capital Markets. Welcome to you both. Jeff, we'll start with you. Where will we see the immediate impact of rate hikes?
I mean, the immediate impact is actually good for banks and financials, right? Those are short-term rates, which is the way balance sheets are positioned, going up. That's good for banks. The concern I would have had was that the pace of hikes might have been too aggressive, and if that happened, would that potentially derail economic growth? I think that's actually one of the positives of what's going on with Russia and Ukraine is it kind of removes some of that uncertainty because the Fed's much less likely to hike too aggressively with all the uncertainty that's out there.
And as we understand it, it's typically any lending banks that would benefit most from this. Would that mean that the regionals are often well situated for rate hikes?
Yeah, I mean, I think that the banking industry in general is well situated for rate hikes, and it tends to be skewed toward the shorter end of the curve. You could probably argue some of the more capital market-centric name, like the trust banks or, a B of A or a JP Morgan, maybe benefit a little bit more from the short end, so they might benefit first. But, yeah, I think definitely from the big guys down to the regionals, higher short-term rates is a good thing at this point.
For the investment banks, Goldman, Morgan, obviously, but even those with investment banking exposure, what's the market environment been like? Do you think it's a headwind or a tailwind for them?
Well, we'll see how it plays out. I mean, when I say that, we're still okay now in that it's been a pretty good trading environment. Sure that there may be some losses on Russian or commodity exposures, but the activity levels have been pretty good on trading. And in investment banking, debt underwriting's held up pretty well. M&A remains really robust. Equity underwriting's where we've really kind of seen things slow down. The good news here is the pipelines are still very strong. There's a lot of deals to get done if the market kind of settles down a bit. The bad news is if the market doesn't settle down, then a lot of those deals don't end up getting done. But I think as we sit here today, the capital markets are still pretty constructive for at least first quarter earnings.
What about over at the Fed, where it appears that Sarah Bloom Raskin's candidacy is running into a loss of support? What would that mean for the banks, for some of the regulation that may or may not be coming down the pike?
Well, I think ultimately what we really need is to get regulators, get governors in the seats at the Fed so things can start moving along again. Some of the bank merger approval kind of delay we've had, I think, has been partially because seats aren't as full. But certainly the more kind of capital and the free markets favorable any names kind of any governors would be a plus for the banks. And I mean, you specifically mentioned one that may be a little less leaning toward the free markets. I mean, I think that as long as the other 3 or 4 that have been nominated kind of get into their seats, that should play out okay for the banks.
Your favorite names right now: Bank of America, JP Morgan, is that right?
Yeah, I mean, look, especially if the revenue environment gets tough or if credit losses start building, scale is going to mean a lot, and they both have scale. With B of A, you don't get quite as much capital markets exposure, and they're more U.S.-centric, so that would be my top pick of the two. But J.P. Morgan's been fairly beat up because of some of their expense guidance, but I think the important thing is that expense guidance is investment-heavy. The environment really gets tough, that could be dialed back quickly. So I think J.P. Morgan's a little too beat up.
Yeah, maybe a warning there for some of the employees, but I take your point about the flexibility. What about Wells Fargo? Do you think they're close to being able to remove the asset cap? And they were, I think, the best performer last year.
Yeah, I mean, to be fair, my associate Scott Seifers covers Wells Fargo, but I think our thinking there is that they're moving in the right direction. And if you're looking for kind of the value bank that's moving in the right direction, that's where you're kind of getting large cap people drawn to. Probably a little bit less so towards Citigroup, which is kind of another valuation-based bank. But at the end of the day, I think Charlie Scharf and company will get things working at Wells Fargo. It's a bit more a matter of when as opposed to if.
Quick final word. Does it matter, or what would you say about the near-term market impact of a hawkish versus a dovish hike tomorrow, and any headwinds that might create for the financials?
I think what we'll hear tomorrow is, 25% basis hike, and I think they'll be leaving their options open, which is what they should do, and I think that would generally be good for the market. I mean, it's interesting that the futures market is, I think, factoring in 6 or 7 hikes now, but it seems in more of my investor conversations, investors are still more in the 3 or 4 hike camp. So any indication they give that maybe the hikes won't be as aggressive as the futures market is projecting would be a positive.